to the African continent, both through the national or the domestic channels that they conventionally have, but also scaling up their regional window and their regional facilities. And so we identified the World Bank as a new partner we could do some innovation with to unlock regionally orientated funds that the World Bank has in place, and that's been increasing over time. So typically what we've managed to do is establish a funding partnership with the World Bank Group. And this is, of course, not something that has been common in our industry. So we're essentially one of the very first who've managed to form such a partnership with the World Bank. And it's, as you mentioned, it's just over $400 million. It's long-term funding. It's intended for regional infrastructure, broadly defined. And it's been quite an innovation, actually. And we're very pleased that the World Bank has also looked at the landscape of financial institutions a little bit more differently. They've opened up and accepted regional banks like ours to become strong partners of theirs. And so we're looking forward to executing on this facility and to sort of also proving the concept, because there's many other regional banks we believe will also want to follow suit in what we've managed to establish. And I should just mention that the World Bank partnership is two in form. You've made reference to the World Bank proper, as it were, but there's also the partnership that we formed with MIGA, which is, of course, one of the institutions in the World Bank Group. And then there's also been some fascinating trailblazing we've done with MIGA as well, separate from the 400 million. That's another 350 million. Yeah.
All right, then we'll get into that MIGA guarantee in a bit, because I'm looking at that many first when you talk about these projects that you're talking about the IFF, that's the Regional Infrastructure Financing Facility. And but I would like to know first how the TDB plans to utilize these funds, and where are you setting your sights on?
Well, we cover just over 20 economies in the African continent, so we have a fairly broad geographic scope, and we're looking at prospective beneficiaries of this funding, and these beneficiaries are intended to be either PPPs or private sector directly. And the idea is, of course, to find sustainable projects that expand energy or also promote connectivity in terms of ICT or transport. And we're trying to do it in a smart way. We're trying to do it in a 21st century manner that tries to advance other agenda items like the Sustainable Development Goals or the climate finance objectives that we have signed up to as TDB alongside others. So we're trying to do a combination of things with this facility. One is, of course, to boost infrastructure on a regional basis, but also to promote it in a manner that doesn't exacerbate debt sustainability considerations or also cause additional carbon footprints by doing unclean energy, so to speak. So these are some of the key aspects, but it's broad because it's not just energy. It's as I said, it could be fiber optic cables, it could be other kinds of ICT projects. Of course, transport infrastructure is very important in the region, and the regional agenda of integration, a huge part of it, of course, is transport. The inefficiencies that the African economies have and the companies they're in has a lot to do with inefficiency in movement of goods and people as well. So we're looking forward to seeing strong contenders looking to take advantage of this facility. We, of course, have a strong portfolio already as it exists that deals with various types of infrastructure, partners, clients, and we do it across multiple sectors. And several of them, of course, are already private. So we have a very good understanding of how to work with private companies or PPPs. And we look to scale up in that regard, working on the experience we've had, the success factors that we've come to understand in terms of how to do this kind of on-lending.
All right, definitely quite a lot there, but I'm trying to understand the impact that you're trying to achieve with these initiatives.
Well, impact is why we exist. We're very, of course, centered on ensuring that we deliver impact. One of the substantive areas, of course, is ensuring that there's just more connectivity, more bandwidth, and that connectivity could be households, and it could be done through partnerships with industrial energy providers. It could be IPPs, but it could also be other corporates who do cogeneration projects and feed various types of users with that kind of power. And so that would be one kind of impact, would be more households being connected to affordable energy, reasonable energy, clean energy as much as possible. But then it would, of course, be more efficiency in transport, and of course, better connectivity in terms of access to bandwidth, so that individuals, whether it's people in schools or just ordinary citizens, wanting to have better access to information and to be able to take advantage of this revolution we've all been so excited about with ICT-enabled business, whether it's finance, banking, but also other areas like e-government. And so connectivity is the critical impact area that we're looking at across various infrastructure sectors.
Definitely quite a lot to unpack there as you go on, and I wish you all the best. But I'm also trying to get from your view, because you mentioned earlier financing models, and I'd like to pick your brain a little to find out which you think is the best fit, especially when it comes to financing long-term infrastructure projects in Africa.
Yeah, it's a good question, because there's been different phases we've gone through. We've just come out of a 10 to 15 year era of public sector driven infrastructure development, which has generated a lot of new assets. It has really helped close some of the gap. Of course, the gaps remain big, in some countries very big, but there has been good progress. But I think what's become very clear now is we need to shift gears, because we don't want to exacerbate the debt sustainability concerns that are already in existence. I think debt sustainability is not at a crisis level yet in most countries, but I think it is heightened. It's increased quite a bit, and so there is need to look at other ways of delivering infrastructure through private participation, whether it's PPPs or purely privately owned infrastructure service providers. We've seen the power of that in the case of telecoms, right? We've seen the revolution in telecommunications over the past 20 years. And these were all vendors, private sector telephone operators, who managed to introduce that quantum leap, that huge leapfrogging we saw in Africa. And now we would like to see some of that happen in the area of generation of power. That, of course, now is embracing new technology in ways we hadn't seen before, thanks to the advances in technology and the reduction in costs of certain technology. But we've also seen the rise of mini grids and alternative solutions to sort of massive national grids. And so that creates even more room for private participation, and we think that can be another innovative way of beginning to press more strongly on closing the gaps without causing public sector sustainability problems on the financial side.
All right, definitely a lot to unpack. I need to hold that thought for a second. We'll take a quick break. I've been speaking to Admasu Tades. He's the President and Chief Executive of the Trade and Development Bank. We'll continue Beyond Markets after the break.
Of place.
It's not a question of temperature.
It's not a question of dedication. In fact, it's not a question at all.
Energy has to be better.
It's our responsibility.
And our commitment to make it better.
For all of us.
Total, committed to better energy.
In challenging times, it is easy to forget what ignited your passion for business. Remember when you were a dreamer, a change maker, a job creator. Recall the promise, the rush, the prospects of success, and the dawn of a brighter tomorrow in the absence of isolation. The new reality of today requires a reboot, a reimagining, and a redirection of ideas. Let's reload opportunities, reimagine growth, renew connections, redirect conversations, regain advantage, revive this economic powerhouse, reignite Gauteng. In us, you have a partner who can open doors, connect you to opportunities, and unlock Gauteng's dynamic possibilities. Remember GGDA.
Welcome back to Beyond Market. If you're just joining us, my guest today is the President and Chief Executive of the Trade and Development Bank in Kenya, Admasu Tedes. And he's been breaking down quite a lot recently, talking about building resilience for trade finance on the continent, talked about some new deals that his organization has been into, and we're going to explore a little more on that. Just before we left off on the break, he was just talking about, the importance of, getting that right financing model, the one that is the best fit for long-term financing, long-term infrastructure projects in Africa. But Admasu, I would like you to take it a step further and find out, in looking at these financing models, and I'd like to get your thoughts on the challenges we're seeing, financing infrastructure in the middle of a pandemic.
Well, it's of course been quite challenging to conduct business in the way that we historically have, and I think most financial institutions are the same. What we typically do is we do due diligence as we consider opportunities to deploy our capital, our funding. And it's, of course, not very easy to do this kind of base work, pre-work to disbursements by, getting to know your client and doing the various appraisals that are typically done when we do these kinds of deal prospecting. So, when you can't meet with clients directly, when you can't go and visit the areas that are being considered for investment, when you can't do the social appraisals to ensure that there's not going to be any adverse impacts on the communities around the area, you need to look at a number of issues before, of course, you can sign off on these transactions. And so we have found ways around it. We've relied more on local partners in the countries where we don't have presence. We do have presence in several countries, but there's, of course, a good number where we don't have presence. And so we've resorted to, relying on local partners in a way that we haven't always. And so we ask others to do some of the work on our behalf, and we try to confirm it and validate and do the quality assurance on our end as well. And so there's been, of course, a disruption in movement, and therefore there has been a requirement to find innovative, technologically enabled ways of doing business, not so different from what we're doing on this interview as well. And so it's not been easy, but we have found ways of bucking the trend. This adverse trend. I mean, just to give you an example, as a trade finance bank, we have embraced what is called, distributed ledger technology, what is called blockchain, and we've used that to accelerate trade finance transactions that require a lot of exchange of information through classical, conventional documentary forms that would typically be the way of doing business. but we've introduced innovations that had not really been introduced yet into this particular practice of banking, trade finance banking, as it were. So, you know, there has been an unexpected benefit of COVID-19 in that it has forced us to actually embrace technologies that have been in place but had not really been fully embraced, so to speak. And so that's been one way in which we've managed to curtail the long time frames that are involved in moving documents from capital to capital, getting original sign-offs and all of that. So now we're moving to digital technology, we're doing digital sign-offs, and the world has moved very quickly to accept that. In fact, I should even say that this novel World Bank regional facility that we signed it digitally, which was also quite interesting because it's not the conventional way in which one would normally sign big loan facilities like this.
All right, yeah, but quite a lot definitely when you talk about keeping up with due diligence and in the line of work that you do. But I would like to speak to liquidity and the financing challenges that are in there as well, because definitely the whole world is trying to deal with this maybe short to medium term shock. We don't know how long it's going to last. But I'd like to know how much finance is available for long-term projects at a time like this when the whole world, like I rightly said, is dealing with the short-term shock like COVID.
Yeah, you know, this has been a very difficult period in the sense that even short-term funding, liquidity has been under serious pressure, especially in the beginning part of the pandemic, where there was so much uncertainty and so much pulling back by capital markets, by banks, by investors across the board. And so, of course, there was a flight to safety, as we often refer to in the industry. And so emerging markets and frontier markets were no longer considered to be acceptable by way of risk. So there was a lot of that kind of pullback going on. So that has been quite systemic. And of course, it did have an effect of choking liquidity, both for short-term trade deals, but also for those that had found success in issuing longer-term bonds, 10-year bonds. In some cases, you had countries that were issuing 20-year bonds, 30-year bonds. Countries like Kenya and Egypt and a few others have managed to issue long-term bonds, Ghana as well. And so that requires risk appetite to be solidly on, and so in the early months of the pandemic there was a pullback, and so both long-term funding and short-term funding got affected. But this is again where the institutions like the World Bank Group, but also other development finance institutions such as KfW of Germany, China Development Bank, AFD of France. These are several strategic funding partners of TDB. We're very happy to see that they bucked the trend and really proved their character by stepping up in this time of difficulty and providing some counter-cyclical effect in the way in which they were looking at our part of the world. So we've been able to raise record levels of funding actually over the past 6 months. We've talked at length of what we've just signed off with the World Bank Group together with MIGA and IDA, about 800 million. But I haven't mentioned what we've managed to do with several other partners, including the African Development Bank Group, the French Agency for Development, AFD, KfW, Badia, which is the Arab Bank for Economic Development in Africa, and even the Koreans have come to the party, and we signed a $100 million facility with a Korean bank just a month ago. So all in all, we've signed new commitments of funding of not far off from $2 billion just in the past 6 months. But these are all what we would call,
all right,
either
I see you've been very busy.
Oh yes, definitely, very busy indeed. And this is why our motto has been go into overdrive when the world locks down, because the world expects you to step up and do a little bit more in this kind of difficult environment.
Definitely doing a little bit more is quite important at this time. And I'd like you to speak to the importance of getting that technical assistance credit along with that World Bank the deal as well, and how this will bolster the TDB's capacity going forward, and also the importance of getting that mega guarantee also at this time.
Well, you know, when you spoke about liquidity and funding gaps in this time, this technical assistance facility also speaks to those constraints and those funding gaps, but it looks to other specific types of gaps related to, for instance, feasibility studies or pre-feasibility studies, diagnostics, the kinds of interventions that need to precede a real facility that would actually deliver implementation funds, right? So in our industry, there's always been this challenge of getting what we call, you know, project preparation funding in place so that you can actually help prepare the ground, the transaction for bankability or for funding. And of course, it's a necessary step in financing any significant project to do, of course, the early work that actually gives you the confidence to proceed with the much bigger sums. And so there's typically a very significant amount of funding that you need to put into place. The rule of thumb is roughly 5% of the capex that would go into a project would be needed in terms of pre-work, pre-financing work. So if it's a $100 million project, generally you need 5 million from inception to go through all the different stages of proving that this project is sustainable and feasible. And that requires special purpose funding, and this is what we were fortunate to be able to get from the World Bank Group. And it was very generous terms. There was 38-year money that would allow us to draw down on this type of funding, special purpose funding, to help unlock deals that we think have a very good prospect of getting off the ground. And so that's what the technical assistance facility was. But there was also another piece that went to our strategic partner, which is COMESA, which is the regional economic community from which we were originated. And they, of course, got a nice chunk of this kind of TA funding. And for them, it was actually grant funding that allows them to work with SMEs and also regional infrastructure projects in terms of the preparation and the advance work. So it's been a very useful type of funding that has been made available.
Definitely quite useful for you, definitely. But I'd like to know how much this guarantee from MEGA will impact your ability to, provide finance to the low-income countries as well, and also the importance of linking that regional development banks to commercial banks at a time like this, and the opportunity this linkage unlocks for trade finance.
Well, this MEGA facility came in at a perfect time in a sense, because it had the effect of just shoring up confidence by the market and the funding counterparts we would normally work with. It just gave them that additional comfort to continue doing business, to continue participating in funding proposals that we had sent out. And what it did is that it actually did two very specific things. It extended the tenor of our trade finance funding. Normally we would raise 3-year money or 5-year money, as we say. This was door-to-door 10-year funding. Even though it is for trade finance, it comes with a lot of breathing room, and it allows us to also benefit from what we call as a grace period, which means you only start repaying the loan in year 5. So it's very attractive in terms of tenor, in terms of the grace period, and in terms of also the cost of the final cost of the financing. And of course, a bank like ours is at the forefront of what is referred to as being a region that has a lot of opportunity, but a lot of fragile economies and a lot of low-income countries, or LDCs, as is referred to in the industry. And these are really very frontier type economies where global markets normally don't tread easily. These are not economies or countries that are rated in any particular way to enable private financing to flow. So what the MEGA facility in effect did was it enabled a bank like ours that actually steps into this kind of very tough neighborhood to actually provide firepower, financial firepower to reach these last mile type economies, if you can refer to it that way. And it's been very developmental in that regard. And so it had an unlocking effect, but it also had an enhancement effect, both on the cost side, the tenor side, and the grace period aspect as well.
All right, then, definitely quite a lot, and I wish you all the best in the work that you're doing, to raise that capital for these economies that need it at a time like this where the world is dealing with the COVID-19 pandemic. I've been speaking to Admasu Tades, he's the President and Chief Executive of the Trade and Development Bank, and that's it on Beyond Markets for today, and thank you so much for being a part of the show. Remember, you can catch the show at 5 p.m. West Africa time, and have access to all episodes of Beyond Markets on our website. That's at cnbcafrica.com. From me and the team, enjoy the rest of your day.
Honesty and integrity to reach for the stars. We must all get down to work to build a better life for all.
Longer. The European Union has suspended its training missions in Mali following the military coup that removed President Ibrahim Boubacar Keïta from power. The two nations train Mali's army and police as a part of international efforts to stabilize the country, which, like others in the region, is facing an expanding threat from Islamist militants. But one EU official said they were frozen because they were designed to support the, quote, legitimate national authorities. Keïta was deposed over a week ago following mass protests fueled by anger at a disputed election and perceived government corruption and incompetence. West African mediators have been negotiating with the coup's leaders over a transitional government, which could give the EU a route to resuming the training. The EU military mission in Mali was drawn up in 2012 and includes more than 600 soldiers from 28 European countries. An additional civilian mission was agreed in 2014 for experts to train and advise Mali's police. Officials said EU training would continue in neighboring Burkina Faso and Niger. And on Wednesday, the situation in Mali was on the agenda for EU defense ministers' meeting in Berlin.
Botswana's government has warned it might not be able to renew a crucial sales agreement with the
It's Thursday, the 27th of August. My name is Kwizera Arnold, coming to you live from Rwanda's capital, Kigali. It's time for Power Lunch East Africa. And on the show today, it is results. Yes, it's a results galore as we look at Rwanda's Agriculture Exports Board numbers. And on the line as well, we have the new chairman of the Nairobi Securities Exchange. The boss have just announced their half-year results. We are going to have a deep look into those numbers. But first, your regional top stories. Now, for the first time since 2015, Rwandan and Burundian military officials have met publicly to discuss and find common ground on the long-standing tensions that have affected security, trade, and movement along their shared borders. Now, delegations of army intelligence officers from both countries met at the Nemba border town yesterday, and in a joint statement to the media, they outlined the outcome of the meeting, and that is expected soon. Now, relations between Rwanda and Burundi turned sour in 2015. Moving on, amidst the growing number of COVID-19 cases, the Rwandan government has directed that curfew hours have been brought ahead to start at 7 p.m. across the country. Now, this is one of the resolutions from a cabinet meeting held last night. So far, Rwanda has reported a total of 3,625 COVID-19 cases with 15 deaths. Finally, Tanzania has banned 3 more Kenyan airlines from its airspace as the standoff over the management of COVID-19 escalates. Now, the Tanzania Civil Aviation Authority has revoked the approvals for Air Kenya Express, Fly 540 and Safari Link Aviation. Now, confirming the move, the Tanzanian Aviation Authority Director General Hamza Johari said that the basis of the decision is the ongoing dispute between the two countries. Now, that's all for today's regional top stories. Let's take a moment to look at how the markets are performing. Now, the Nairobi Securities Exchange 20-share index declined by 0.3% or 5.3 points to 1,743 from the previous 1,748. Now, the 25-share index, on the other hand, increased to 3,071, or by almost 1% from the previous 3,044 points yesterday. But that's not what we are here to discuss right now. We are looking at the BASI's half-year results, and joining us for this is the newly appointed chairman of the Nairobi Securities Exchange, Mr. Kiprono Kitoni, who's speaking to us from the BASI's offices there in Kenya's capital, Nairobi. Thank you for joining us, Mr. Kiprono, and thank you for making the time. First of all, congratulations on the appointment there as the chairman of the most active BAS in the region.
Thank you very, very much. It's a great honor and a privilege to be chairing the BOS, albeit at a very difficult time. The global economy is impacted by COVID. Market sentiments have been on the decline, but I do believe there's a lot of upside, and I'll be talking to you about that in the course of this interview.
Okay, before we dive into the numbers, let's just try to dive into your legacy or potential legacy. What are you looking in achieving as a chairman of the Nairobi Securities Exchange?
First and foremost, in Kenya, we believe we have a very vibrant and active capital market. We have a very good regulator by way of the Capital Markets Authority. We have the NSE with 60-plus companies listed. There's a lot of participation, very many active counters, some amazing companies like Safaricom and Equity Bank under our purview. And we believe that in the years ahead, we are going to be focusing a lot on additional listings. We're engaging the government's privatization commission. We intend to also look at other large private enterprises to list in the market. We are reviewing the incentives that are provided under the listings schedule, and to see if they're still relevant 20 years on. And we have a very, very positive outlook about the future. Actually, surprisingly, notwithstanding COVID, our financial performance has not been bad. And there's actually been increased traction in the last few weeks, and we are confident that we can build on that to deliver a strong full-year performance.
We were going to get into those financials, but your tenure and appointment comes amidst a global pandemic. With that comes, its own challenges. What are those that you expect, especially going into the final half of this year?
You see, many organizations globally are very highly impacted by COVID, and many organizations, many companies in the tour and travel sector, in the fast-moving consumer goods sector, in manufacturing, in transport and logistics are all affected by COVID. And I think that there is no economy that has not been adversely affected by COVID. And for us, we will be looking at our strategic plan. We'll be looking at the 4 pillars as a way of really building onto some gains. These 4 pillars of our strategic plan include sustainable business growth, operational excellence, our people. We have a very strong and competent team at the NSE and also running many of the listed companies in Kenya, as well as strategic partnerships. We want to really position Nairobi as the boss of choice in the East and Central Africa region. And we want to look at strengthening linkages, partnerships, with the Lagos Stock Exchange, with the JSE in Johannesburg, with Cairo, and really to work under the momentum that has been created by the AfCFTA, which is really looking at a holistic market in Africa, and Kenya being a very significant cog in the wheel.
Now, we just spoke to the newly appointed Auditor General in Kenya, and it's public knowledge that the office has been running without a boss at its helm for the past 1 year, and that in a way affects auditing of your companies at the Nairobi Securities Exchange. How is the appointment of a new Auditor General a year later? How do you think that is going to help boost the performance of the NSE?
I think I want to make it very clear that we are not operating under the purview of an Auditor General. The Auditor General's responsibility is to audit government and government-owned organizations in the parastatal sector. The Nairobi Securities Exchange is regulated by the Capital Markets Authority and also has its own internal audit mechanism. But then it is a very good sign by the government of Kenya now appointing an Auditor General. It shows the commitment of our government to proper audit. I mean, the process has been long going, but as I say, it's never too late. And the fact that we have one appointed now is a significant step forward to ensure that our government is accountable and that the taxpayers' funds that are in use by government are put into good use. And as you can see also, our anti-corruption agencies are working full blast. Yesterday, our president announced an investigation into the use of COVID funds. So I think there's a lot of things that are happening that are all in the line of good governance.
I really want us to talk numbers, but just before we get into those, we want to look at our regional outlook. What do you expect and what do you hope to achieve in your tenure in regards to the various, or as the big brother, of the other bosses in the region in terms of more linkages, more working together, and more cross-listings?
We intend to achieve 5 things in the 3 years that I will be in office. The first one, of course, is more listings, which I'm committed to. We have engaged the government of Kenya, and yesterday we got the commitment of the Cabinet Secretary, the National Treasury. We shall be working in a committee together with the Capital Markets Authority and officials from the National Treasury to come up with a clear roadmap for more listings from the Privatization Commission of Kenya. You know, we are looking at persuading governments to on-sell and down-sell more shares in Safaricom, Kengen, and to look at other organizations in their ambit, such as Kenya Pipeline and others. We also are going to be targeting the private sector, where there are many very profitable and robust companies. The second thing, of course, is to focus on good governance. There is empirical evidence that long and sustainable profitability is directly linked to good governance. Thirdly, we'd like to enable Kenyan companies to access green climate funding. You know, the Green Climate Fund is a huge ticket item globally, and I don't think as a continent we've been able to achieve that scale in terms of accessing green climate funding. Fourthly, like I said, we want to deepen our strategic partnerships. We want to work with other bosses, and we really see Kenya, the Nairobi Securities Exchange, as the focal point for capital market activity in the Eastern Central African region. We want to increase liquidity. We'd like to see more cross-listings with Rwanda, Uganda, and Tanzania, and even further afield into Johannesburg, Cairo, and Lagos.
Just please don't get off the line, Mr. Kiproti. We are going to take a quick short break. We're going to take a quick short break, but we are coming back to talk capital outflows, performances in last year, and possibly we're also going to look at the new ETF gold trading that's happening there at the Nairobi Securities Exchange. That's the Nairobi Securities Exchange Chairman, Kiproti Kitoni. He is still on the line. We'll be speaking to him after this short break.
All your years of paying tax, you still wonder, why does it matter? It matters now more than ever. It matters to those who are always at the heart of any crisis, and our future generations. It matters to all of us. To all taxpayers, pay your fair share. Do it for your nation. Your tax matters.
They say the journey of 1,000 miles begins with a single step. Sometimes, that first step is the most important one we can take.
There's Mr. Mandela, Mr. Nelson Mandela, a free man taking his first steps into South Africa.
Leading us to the discovery of newfound hope, where we finally start to reap the rewards of the long miles behind us. We have come a long way, connecting people and places. And as we head out into the future together, we'll always be here, making sure you put your best foot forward. So, here's to you and to your journey, wherever it may lead.
You're watching Power Lunch East Africa, and we are still with the newly appointed chairman of the Nairobi Securities Exchange, Mr. Kiproni Kitoni, there speaking to us from Nairobi. Now, diving into the numbers quickly, performance of the BAUS remains subdued in the first half. A lot of that has been put down to capital outflow. Any other challenges that have led to the almost 6% revenue turnover by the BAUS?
I think, like I mentioned earlier, we are also impacted by the circumstances around COVID. You know, there was a GDP decline in almost all economies, and in Kenya, we saw our GDP sink to -5 in March, soon after COVID was announced, the lockdowns. But that has since recovered, and we are now in positive territory of 3.1%. So that, if we look at that macroeconomic perspective, it has a knock-on effect on market performance. So, notwithstanding that, we have still been able to show a profit in our half-year results today of 110 million Kenya shillings. And the figures, in our opinion, the revenue is very marginally reduced. Interest income was also reduced marginally from 47 million to about 36 million Kenya shillings, as well as other income for the same period has also been slightly impacted. But I would say overall, we are quite satisfied that the performance that we have shown today is a clear reflection that all is not lost. We are still in profitable territory. If you look at our balance sheet, there's been a growth in our balance sheet, and share in profit in associated companies has also increased by over 100%. And total assets have also marginally increased by, albeit a small amount of 1%. But we are confident that these results are an indication that there is still a good value proposition for our share. The share value of the NSE today is at a fairly low value, and it is I would like to encourage investors to seriously look at investing in the NSE, because the plans we have ahead in digitizing, as you know, Kenya, 30% of Kenya's economy is transacted on M-Pesa, and we have a lot of radical and novel plans to increase share participation in the local communities, and we are confident that this company will perform very well into the future.
Talking about M-Pesa, which is there with Safaricom, those are some of the blue chip listed companies on the NSE, and they seem not to have been really affected by the COVID-19 pandemic. What do you put that down to?
You see, one of the measures that was taken after COVID-19 came was social distancing, and obviously we are aware of the government guidelines regarding cash payments. One of the biggest services or offerings by Safaricom is M-Pesa, which is mobile money transfer, which is today the intellectual property of these Kenyan corporates. And, you know, just by virtue of the fact that, you know, cash transactions were discouraged, there's been a huge surge in M-Pesa transactions. And apart from that, I think Safaricom has also been very innovative and very forward-looking as an organization. And we are seeing that, together with many other companies, able to be resilient even during these very challenging times. So, in my opinion, you know, the measures taken around COVID have been perhaps a shot in the arm for some of these services.
Let's run into the bonds. The turnover retreated, to be exact, by 18.3% from 359 Kenyan billion there to about 293 billion end of June 2020. Now, could we put this down to that downgrade by major rating agencies there?
Well, I wouldn't say that. I mean, of course, the downgrading of rating has an impact on its own. But at the same time, you must remember that the government's financial year runs from June to June. So the July of every year is the beginning of the financial year. So the last quarter, our last financial quarter, as an exchange that obviously was marked by the shift in the government financial year then. For that reason, government did not go into the market with the bond offering, and that hence led to the decline that we have seen. But we are, however, confident. I mean, if you look at the equities, for example, I mean, there has been still an increase, and we are confident that now the government's year is back, and we shall see a surge in our bond income.
But there was also, you know, a reduced secondary activity there on the BAUS. That is reflective, and that was in reaction to the remarks by the ratings agency. Couldn't that have had an impact?
Are you talking about bonds or equities?
I'm talking about bonds.
Yeah, I mean, bonds turnover has marginally declined. I mean, in 2019, the same period, we had 359 billion in bonds turnover, but today it's 293.8. Yeah. But for the reasons that I've given you, I mean, the rating agencies, of course, have had a slight impact, as well as the reasons I have just cited about the government's financial year ends.
What do you think about the selling pressure by international investors, and what kind of impact it's going to have on the bourse in the long run?
You see, international investors come in for bonds and for equities, and we've seen our equity turnover increase marginally. I mean, at this same time last year we were at 78.1 billion, but now we are closing at 83.2 billion. So Kenya is considered as a frontier market, and there's always cyclical activity. And when you see major international markets surge, or rather show upward trajectories, like the United States, the New York Stock Exchange, and others, then there's normally an outflow of investment funds from our frontier markets into those markets. It is cyclical, and for us, it is not nothing much to worry about. But from a strategic standpoint, I mean, you know that close to 70% of trading activity, that's both in bonds and equities in our market, are foreign control. And we want to really work on deepening our interaction with the local investor community. And when I say local, I don't just mean in Kenya, but farther afield in East Africa and the rest of Africa, to be able to level this out to 50-50 so that we are less impacted by outflows as we have witnessed in the last few months.
So could you say this about 26.8% drop or capital outflow from the foreign investors is an opportunity for domestic investors?
Absolutely. And in fact, one of the things that we are planning to do as a strategic imperative is to engage the collective investor pools in Kenya. As you know, there's a very strong savings and credit movement. There's a very strong cooperative movement. We'd also like to engage mutual funds, insurance companies, and pension funds in Eastern Africa to invest more in our markets. So we see it as an opportunity. It has had, of course, its own downward pressure on the price of shares. And for us, that presents a unique opportunity for investors to get in at this time.
Also looking at your interest income there, it decreased by 22%. Does it mean investors are looking for safer investments? And if so, how do you plan on creating safer investments to keep you in the game?
Yeah. You see, our interest income declined for other reasons that perhaps are not reflected in our income statement, that in our financials. One of the reasons why you're seeing our interest income decline is because part of the deposits that the company has, and as you know, the NSC is a very cash-rich organization, were used to make strategic acquisitions. We are also investing in other subsidiary companies, and we were able, in the course of the financial year, to liquidate some of our deposits for strategic investments, hence the reduction in interest income.
Thank you for making the time there, the chairman. That was the Nairobi Securities Exchange chairman, Kiprono Kitoni, speaking to us from Nairobi, Kenya. Now, quickly moving on, traditional exports have seen a great dip as major supply routes were affected, but Rwanda tea and flour exports have seen an increase now in the first half of the year, despite effects of the pandemic. Now, Cynthia Uwachu, who is the Export Market Development and Innovation Division Manager at Rwanda's National Agriculture Export Board, spoke to us earlier for more on this.
Within the horticulture sector itself, really access to markets is the biggest thing that we need to advocate for and keep pushing for. Not just access to the markets themselves, but the logistics to get our produce into the markets that they need to go into. Traditionally, we're exporting about 80% to the region and a really smaller amount to Europe, mainly Europe. But during since March up to now, we're shifting towards more focus on the European markets and not as much on the regional markets because of the restriction, on movement. So we've seen export volumes to a certain degree go down, but the revenues, on the other hand, kind of increased because we were now focusing on our higher yield markets.
If we're talking about our traditional, when you're talking about high yield markets, are we talking about exporting the traditional exports, coffee, tea, or are we looking at diversified agricultural exports?
It's basically a combination of everything. Specifically within horticulture, that's where I was saying the market trends have shifted, and we're focusing on the European markets more than we are on the regional markets. But when we're talking about tea and coffee, those have remained the same. They've remained the same. We've had the same main export markets for tea over the last couple of years, and coffee as well has remained the same. However, with the effects of the pandemic and the different restrictions that are around the world, of course, all the commodities have been hit differently. Whereas we've seen that volumes as well as revenues from tea have increased over this half-year period, basically from January to July. When we're comparing it to the previous year, for tea we've seen an increase, but for coffee we've seen a deep decline, almost up to 50% decline from what we were making during the same period last year. Mainly because with the restrictions that are ongoing, cafes are closed, restaurants are closed, and these are usually the places where you'd expect to find specialty coffee. So whereas for tea, domestic consumption, as in consuming tea at home, has not been affected. But we're seeing an increase in home consumption of coffee as well, which is leading to us also trying to see how to re-strategize and focus a little bit more on the roasted or the value-added coffees, so that we can take advantage of this time when everybody is at home and they're ordering their coffee ready to be brewed at home.
Cynthia, before we get into the numbers, how capital intensive is that new strategy?
Relatively high, but the returns are also relatively high. So it's a worthwhile investment.
Okay, let's look at the numbers. Coffee dipped by almost, coffee sales volumes, I believe, all sales from coffee dipped by almost 50% at 46%. While tea, on the other hand, seems to have picked up greatly as a result of the pandemic. Should we put the growth in tea revenues down to the pandemic in particular, or is it down to previous campaigns and strategies to push Rwandan tea?
It's not just the pandemic, and the pandemic didn't add anything extra to what we're already anticipating and projecting to see this year for tea. There was a lot of input and a lot of investment that was put into the production side, which led to an increase in the volume of the tea that we had, like made tea, to sell. So with already more tea to sell, that more to export. But then we received fairly good prices throughout, basically from January up until May. Our prices were on average higher than.
Cynthia Uwachu, Export Market Development and Innovation Division Manager at Rwanda's National Agriculture Export Board, speaking to us earlier. Now that's all we have for today's show. Feel free to tag us on Twitter at CNBC Africa using that hashtag PLEF410 or myself at The Real Quizera to be part of that conversation. You've been watching Power Lunch East Africa. After the break, it's Power Lunch South Africa.
As Africa and the world face our biggest challenge in recent history with the COVID-19 pandemic, we must remember one thing. We are in this together. Your continent is fighting alongside each and every African, every step of the way. The African Union, chaired by South African President Cyril Ramaphosa this year, together with peer African leaders, has been hard at work to find lasting solutions that will ensure that Africa beats this and any future pandemics to come. Through their united efforts, the African Union has raised over $60 million. Africa has shown unity and leadership in protecting its citizens and managing the spread of the pandemic with world-class expertise and resolve. We have called for debt repayments to be paused and even cancelled, freeing up billions of dollars to fight COVID-19. Africa is united. Together, we will overcome.
Hi, good afternoon, everyone, and welcome to Power Lunch South Africa with myself, Fifi Peters. A lot to get through on the show. Quite a number of results out this morning, and we'll be walking through them with the respective CEOs, that is Massmart and also Grindrod. We'll speak markets and what the general expectation is ahead of the Fed Chair Jerome Powell's speech later on this afternoon. You can follow the conversation with us. That hashtag to use is PLSA410, and you can tweet us at CNBC Africa. Tweet me at Fifi Peters. Let's get started with some latest economic data coming out of South Africa in the form of inflation figures. We have seen the rand relatively unchanged following the release of the increase in producer inflation. Producer inflation rose to 1.9% in July, which was slightly ahead of expectations. The increase in producer prices does follow an increase in consumer inflation last month. CPI came in at 3.2%, returning to the Reserve Bank's target band. And company news, the JSE has fined AO Technology Solutions 6.5 million rand for material errors in the group's audited 2018 and 2019 interim results. The JSE says that these results were published to the market despite knowledge or sufficient internal and financial controls. And the finance team, it seems, was also or did not have sufficient historical and technical knowledge of the company. AO has said that it does accept the JSE's findings. And negotiations between Botswana's government and De Beers have been slowed down by the COVID-19 travel restrictions. This could lead to a 10-year sales agreement between the two parties not being renewed before the end of December, and that is when the current one is expected to expire. Let's take a look at how the situation is unfolding.
Botswana's government has warned it might not be able to renew a crucial sales agreement with De Beers before the end of the year, as lockdown measures have delayed negotiations. The 10-year sales agreement, which expires at the end of December, is necessary for Debswana, a joint venture between the Southern African nation and the leading diamond producer. The company provides Botswana with around 2/3 of its foreign exchange and 1/5 of its GDP, and is also the source of 70% of De Beers diamonds and 90% of its sales. But Metia Masire, Permanent Secretary in the Ministry of Minerals, said that though negotiations have resumed, progress has been slowed by travel restrictions. De Beers, which is part of Anglo American, said it could continue to operate under the existing agreement temporarily in the event of a delay. But such a holdup would also set back President Mokwesi Masisi's efforts to create jobs in a country with high unemployment.
All right, so let's put the focus on the markets and how your money is moving for you at this lunch hour. A relatively positive start for the JSE. The Rand not really doing much, but joining us to unpack exactly what is going on in the current trading session is Gary Boyson, Director and Portfolio Manager at Rand Swiss. Gary, always a pleasure. I just really get the feeling there's a wait-and-see approach being taken until Jay Powell gives you guys a lot more clarity on his thinking about the current situation. What will you be looking out for in his speech later this afternoon, Gary? Good afternoon, by the way.
Hey, good afternoon. Thanks for having me on the show. Yeah, if you have a look at it, if you look at the expectations from Fed, it's very different to how it used to be. So we're no longer just looking for hints at whether interest rates are going to rise or fall. It's really all about what alternative monetary policy tools the Fed is going to use. If you have a look at federal funds futures currently, pricing out to March 2021, you have a 100% chance of interest rates staying basically at the zero bound rate. So, Fed fund, at least the federal rate at 0 to 25 basis points, which is essentially, it leaves us in a position where we have to kind of try and understand, the quantitative easing tools that are being used and the method in which the Fed is expanding its balance sheet and how that potentially can affect asset prices. So there's a lot to be said in the speeches. I mean, there's all sorts of different guidance that they could potentially give. Adopting, specific employment targets. I mean, they've spoken at length about, the monetary policy in the US being very dependent on almost the day-to-day data that they're receiving around the coronavirus. The coronavirus is obviously still very much at the forefront. So I think it'll be interesting to see what comes out of it. But at this stage, I think you still have most market participants. It used to be, I suppose, it was the Bernanke put and the Yellen put. But essentially, they feel that there is a significant amount of protection that the central banks are providing for certainly equity markets and other financial markets. And because of this, you've seen that the sharp recovery in certainly equity prices internationally and to a large extent locally as well. Just with this belief that it doesn't matter what happens in the underlying economy, the central banks are going to step in and keep asset prices inflated, and investors do have that shield at any one point. So with that kind of in mind, it's very difficult to be bearish on financial markets no matter what happens in the real economy.
All right. Of course, I mean, that recovery that we are talking about mostly across the financial markets in the US specifically is what, around 6, 7 stocks? I don't know, I lose count nowadays. I'm just focusing on the FANGs. But Gary, ultimately, everything that the Fed has been doing thus far has been to try and support the economy, obviously, but also try and get some inflation in the system. And we are reading of our inflation numbers ticking higher there. You spoke about their monetary policy tools, and I know that going into this meeting, there's been a lot of talk around their average inflation targeting and also the possibility of yield curve control. What's your thoughts of those two major themes when it does come to U.S. Treasury specifically? How is it informing your view of putting your money in that space?
So it's a good question. You've got to go back to the history. If you start with inflation targeting, you look at the history of inflation targeting. Since that regime essentially moved into central banking, you've seen a dramatic shift in the way that inflation behaves across the globe. Because essentially the central bank is setting the expectation on where they are going to act, and that shifts a lot of the responsibility back to the market. In years, if you look, let's say 30 or 40 years ago, you didn't have an inflation targeting framework, so there was no idea on you kind of had your expectations of inflation, but you couldn't I suppose, determine how a central bank would act. You can now determine how a central bank will act depending on where inflation levels are sitting. And it's one of those reasons that we've seen inflation come so under control in let's say the last last decade and a half in certainly in developed markets, but also in, to an extent in South Africa as well. I mean, I don't know if the viewers will remember all the way back to when we had interest rates of 20% trying to tame really out of control inflation. That doesn't seem to be a risk at the moment. I mean, our inflation is well within the target, and it doesn't seem like it's going to creep outside anytime soon. That said, our local inflation, though, we are sitting in a very different position from the US markets in that, being a much smaller economy with very open borders, we are reliant to a large extent, especially, let's say in the consumer price basket. Now, each consumer price basket is different depending on who you are. We have the official one, but that doesn't necessarily reflect, let's say, Peter's inflation basket. We will start to see the prices just with the weaker currency that we've experienced. You are going to start seeing the prices of imported goods starting to rise in South Africa. If we can't manufacture those goods locally, we are essentially price takers, and we are going to have to take it at vastly expanded levels. Just a quick comment on yield curve targeting. That essentially, you're controlling what happens at the long end of the bond market, through these massive asset purchase programs. And again, you have to be cognizant when you put a program in place like that as a Fed who has essentially the unlimited ability to expand its balance sheet. You are setting expectations in the market, and markets will react accordingly. In that they won't see, let's say, long-dated bonds as viable investment options. And once again, that forces money back into the equity markets. If you look at a 10-year US Treasury at the moment, I think your total yield for 10 years is something like 5.5%. You're going to be compensated 5.5% for lending the US government money for 10 years. You then essentially, like if you look at kind of the risks there, I mean, often investors are then starting to focus on these mega cap large companies like Apple, who have a lot of cash on their balance sheet, but also have the ability to generate earnings as well. And they use, I suppose, a different mechanism for investing. So it's one of the reasons I think that we've seen the FANG stocks, as you mentioned earlier, rising as much as they have.
Mm-hmm. Well, Gary, unfortunately, we are out of time. I know there was a lot more to discuss, but hopefully we'll get that in next time. That was Gary Boyson, who is the portfolio manager as well as the director at Rand Swiss. Another interesting development there in the US, of course, the concerns around Hurricane Laura. A lot of concerns there, and it seems like local company Sasol has also reacted to that, closing its Lake Charles facility because of that. So that's a story that we'll also be watching closely. Let us go to a short break. When we return, we start unpacking some of the numbers out today, starting with Grindrod. So stay with us.
Naledi is 30 and will continue saving 3,000 Rand a month towards a retirement annuity until she's 55. How would this R8 look if she switched to Outvest? With Outvest Revolutionary One Fee, she'll pay 78% less in fees than with some traditional investments. And with performance of selected funds comparable to their competitors, Naledi could get over 2 million Rand more when she gets to 55. Go to outvest.co.za or SMS out to 32337 and we'll call you back.
In challenging times, it is easy to forget what ignited your passion for business. Remember when you were a dreamer, a change maker, a job creator. Recall the promise, the rush, the prospects of success, and the dawn of a brighter tomorrow in the absence of isolation. The new reality of today requires a reboot, a reimagining, and a redirection of ideas. Let's reload opportunities, reimagine growth, renew connections, redirect conversations, regain advantage, revive this economic powerhouse, reignite Gauteng. In us, you have a partner who can open doors, connect you to opportunities, and unlock Gauteng's dynamic possibilities. Remember GGDA.
Welcome back. Shipping and Logistics Group Grindrod has reported a wider loss of 34.2 cents per share in the 6 months to June. This is a 92% increase to the loss reported in the previous comparable period. Joining us to unpack the numbers is Andrew Waller, who is the CEO of Grindrod. Andrew, thanks so much for your time. What we have seen since the COVID situation began and the subsequent lockdowns is a lot of port and shipping activity being disrupted by that, and it is being reflected in your results. My question to you is, have you seen a change in the situation since June? And are you expecting things to perhaps get a bit better from here on?
Indeed, Fifi, we have seen a tremendous change since June. In fact, we were very fortunate as Grindrod to be able to operate under some of the lockdown conditions at the higher levels. But with the borders opening, we've seen quite a change now. A lot of minerals now finding their way to the ports and up to the markets in the world. In particular, iron ore, very strong, copper strong. So those have helped us immensely. On the other side, on the container side, a little bit subdued inbound. And that will obviously depend on how quickly the South African economy comes back on stream. But yes, good exports of minerals and exports of citrus too. We had a bumper season of citrus. The volumes are well up for South Africa on the export side.
I mean, in terms of shipping activity, many people look at it as an indicator of where the economies are headed. And I'm just wondering, from the kind of activity you're seeing in your books from your clients, how you see the shape of South Africa's economy specifically from COVID-19.
So I think what we will see is certainly on the mineral side, we will see good volumes with the prices as they are. That helps the mining sector and, of course, the logistics as we make sure that commodity gets to the ports of China, who utilize a lot of that minerals. As I said, the agri is well done, and we've had a great season for citrus out of South Africa, so that'll be good. Going forward, we all worry about December, and will we have that year-end peak that we always have had in the past? At the moment, the volumes of inbound containers are, as I said, a bit light. We, as a company ourselves, are managing to make ends meet by operating all sorts of contingency solutions for the shipping lines and the customers. We're finding